Good morning, sir, and good morning, friends. My name is Yanti Antini. I'm from accounting class D. This morning, I make video about a balance sheet. What is a balance sheet? A balance sheet is a must-have report for a company that can be used as a basis of the company's business decision. Balance sheet or statement of financial position is a part of an entity's financial statement produced in an accounting period that shows the financial position of the entity at the end of the period. The balance sheet consists of three elements, namely assets, liabilities, and equity, which are related to the accounting equation. Three elements in the balance sheet. Number 1, assets. Assets or assets refer to the entirety of the resources that your business has based on the period of time. Assets are categorized into three types, namely current assets, fixed assets. Current assets are current types of assets that have a short-term useful life, where the disbursement process is less than or a maximum of 1 year. B. Fixed assets. Unlike current assets, fixed assets are assets that are owned or used for a longer period of time, more than 1 year. The nature of fixed asset is not to be sold, and the buying process is carried out for the smooth operation of the company. Some examples of accounts that can be grouped into fixed asset accounts include land, buildings, machinery, and equipment. The fixed assets have another form, namely intangibly fixed assets. Intangibly fixed assets are intangible assets that are owned by a company but do not have physical form. Included fixed assets include copyrights, patents, and trademarks, or copyright, and rental right. 2. Liabilities. Liabilities are company obligations to other parties that must be paid, but in the short and long term. Included in the liabilities include debt, income received in advance, revenue earned for services that have not been done, and accruals fees that fall due later. The liabilities are divided into two types, namely current debt and long-term debt. A. Short-term debt. The type of debt is that must be repaid immediately with a deadline of no later than 1 year. B. Long-term debt, which includes long-term debt is all debt whose payments are relatively long, such as bond debt, bad mortgage payable, and so forth. 3. Capital or equity. Based on the reciprocal relationship that has been described above, capital, or also known as equity, can also be interpreted as the differences between the components of asset and debt. Debt capital contained in a balance sheet is the balance of the final capital of a business. Simply put, this component is obtained from the difference of the excess flow of assets with liabilities. The added flow is the right of the owner of the company. Examples and forms of the balance sheet. There are two forms of balance sheet presentation, i.e. control or account and staple or report. Number one, staple form or report. The presentation is made sequentially starting from assets, liabilities, and capital. Number two, control form or account. This form of report presents accounts in two sides. The right side is usually liabilities components consisting of liabilities and capital, while the left-hand side is an assets that contains all the assets classification accounts. Benefits of a financial balance sheet. Financial balance has several benefits, namely as a tool to analyze and effective of changing financial conditions periodically from year to year, both historical and futuristical. As a tool to analyze the liquidity of a business, which shows the ability to pay and buy of short-term debt with liquid assets on it. As a tool analyzes the solvency of a business, which shows the ability of companies to immediately pay off their short-term debt before they do that. Thank you and good morning.